It's closed by Mo. I had to redo this intro music because I have no idea how to import the last one. Bye.
What's up, guys? Welcome to this week's episode of Closed by Mo. My name is Mohammed. I am your host, as well as real estate investor and realtor based out of the Empire State of New York. My focus areas as a real estate agent are the 5 boroughs of New York City, as well as the 2 counties that make up Long Island. Now, in this week's episode, I want to talk about something that I've been experiencing quite a bit with boots on the ground as a real estate agent in a lot of the parts of New York City and Long Island that I cover with my clients. But before we jump into that, I actually want to zoom out before zooming in further. So we're going to spend a little bit of time early on discussing what's happening in the macro environment with interest rates and inflation, because that's going to give us a really good idea of why things are unfolding they are in everyone's local markets. Of course, I'll be talking about my local market, but I feel like wherever you are, things should still apply, because if you're in North America, or especially in the United States, the interest rate changes are definitely affecting you in one way or the other. Without further ado, let's jump into it by starting to talk about the macro environment. All right, guys, now let's jump into what's actually happening in the macro environment. So I hear about a lot of buzz in the media about how there's a lot of record high inflation rates and how the government is trying to curb that inflation with record interest rate hikes, the likes that have never been seen for decades. But before explaining exactly how those are related to what's happening in the local market, I just want to pause and rewind a little bit, take you guys back to maybe the first or second quarter of 2020. As the world slowly descended into chaos because of COVID-19, the United States Central Bank stepped in and pumped in more than $2 trillion into the US economy to keep the economy going, to make sure that people could still make their rent on time, their car payments, their home payments, whatever it was, in the form of either stimulus checks or subsidies or loan modifications or loan payment being paused. These were a lot of things that the Federal Reserve stepped in to make sure that the economy didn't completely grind to a halt. And now we're facing the aftermath of those effects. I've written about this in my blog as well, and I'll put the link in the description below. But let me give you a bit of an idea of what exactly the central bank is trying to do now. So the Fed or the Federal Reserve or the central bank, whatever you want to call them, these are all the same name for the exact same thing, which is the United States Central Bank. They have two core responsibilities. The first is to maximize employment by keeping unemployment low. That's it. Pretty straightforward. The second is to stabilize prices for regular consumer goods and services, right? Now, employment is at its highest levels it's been in the last few decades. This is a very good thing, right? Low unemployment, everyone's super excited about that. Everyone's got a job. That's fantastic. However, if you live in the United States, then you know firsthand how the prices of things have recently been jumping up quite regularly. So the central bank now is trying to curb in those unstable prices, excuse me. So how is it going to be doing that? Now, if you've taken any intro to econ course, you'll know that market prices are determined by the quantity of demand and the quantity of supply of goods and services, right? So the central bank is now looking at this and wondering, okay, how do we stabilize these record high prices? We can do one of two things. We can try to affect the supply, or we can try to affect the demand. Now, trying to change supply overnight isn't an easy thing. It just doesn't happen, right? Especially the supply of raw goods and services. That takes a lot of time to affect. However, affecting demand, that's definitely a lever that the central bank can pull quite easily with raising the interest rates. So how does actually raising interest rates affect the level of demand? Now, you have to remember that supply and demand chart, right? As market equilibrium is high, if you're trying to bring down that price equilibrium in the market, you have to reduce overall demand. Now, by increasing interest rates, the central bank is now effectively increasing the cost of borrowing money. So if the cost of borrowing money is high, people are less likely to borrow money, there's less money flowing through the economy, and of course that affects overall demand, so people are less likely to demand too many goods and services. With lower demand, prices start to drop. Pretty straightforward. Now let's talk a little bit more about how actually that affects what's going on in the local markets and what I'm seeing day to day as a real estate agent in New York City and Long Island. Now that we have a good understanding of what's happening in the macro environment and the what behind the why when it comes to interest rate hikes, let's take a look at actually what I'm seeing on a day-to-day basis as a real estate agent with my local markets. Now, I've noticed there's been quite a few price adjustments, both within Zillow and the MLS, that I'm noticing. A lot of homeowners are reducing the prices of their asking numbers, which is pretty good for buyers. I've also noticed quite a handful of houses have been coming back on the market. Now, what that means is they were originally listed, then they had an accepted offer, they signed contracts, and then something happened in the middle there where the house had to be relisted again by the agent. Now, what I'm seeing, what I'm actually can extrapolate here, is that the house went under contract for a specific purchase price paid or promised by the buyer. The interest rates rose, and now the buyer has been kicked out of their budget because their pre-approval no longer stands with the offer price that they gave. So unfortunately, they weren't able to get the financing that they wanted, which is a good thing for new buyers that may have stronger financing, but not the best news for people that really like that house and now it has to go back on the market. I'm also noticing very anecdotally that my open houses aren't as busy as they used to be before. Typically, when you do an open house with a well-priced listing that's in a very good neighborhood, you'll have a list of participants through the door and almost past the sidewalk around the block. That's just not happening anymore. You'd be lucky if you get around 5 to 10 people come to your open house on a Saturday or Sunday afternoon now. Now, what I want to look at though is a new statistic that I learned, which is called the absorption time data. I hope I'm not butchering that name. I learned about this a couple of weeks ago through a training course I took for my MLS system, and I wanted to share that with you. Now, basically what the absorption time data tells us is everything else held constant. The current inventory in your market with the current demand, how long is that going to take to get fully absorbed? As in, how long are all those homes in that market at that point in time with that same demand going to take to get completely absorbed by that existing demand? So the higher the number, the more of a buyer's market we're in, because the higher the number, it means it's taking longer for those homes to get sold and bought by specific buyers that are demanding those homes. The lower the number, it means there's less inventory than there is demand. So demand is greater than supply. The higher the number means supply is greater than demand. Now let's take a look at what the chart tells us about the 3 specific neighborhoods that I've recently been working in: Jamaica and Queens, New York, as well as Baldwin, Levittown, which are both towns out in Long Island. Let's see what the chart tells us.
This graph is really cool to see because, as you can tell, the absorption time for all 3 of those separate markets has been steadily increasing, particularly right from the March-April timeframe. So number 9 on the x-axis being around that March-April month. This is really interesting to see as an agent because it tells me that, hey, market is slowly shifting into a buyer's market, because as absorption time increases, we already know that it's taking a longer time for the current listings, as in the current houses for sale on the market, to get bought out by the existing number of buyers. So let's dive into a little bit about what this data actually means for us now.
So what does all this data mean for us at the end of the day, and what are our key takeaways? For me, there's 2 main points to take away from this video. Number 1, the central bank knows what it's doing, right? They know that by increasing interest rates, they're going to be able to destroy demand and hopefully stabilize those crazy high prices we've been experiencing for the last year and a half or so. And second thing that's very important for me on a day-to-day basis, the market is slowly shifting into a buyer's market. That's very important because if you're still a buyer and you have a strong approval amount, the next several months are going to get a lot better for you, because if you're still intent on purchasing a house, it means you're going to be competing with less borrowers out there. It means there's less buyers, so there's less competitive offers on a specific property, meaning you have a higher chance of getting your offer accepted, which is fantastic news for you. With that, I want to thank you guys all for watching this video through the whole and hopefully not skipping through it. If you really enjoyed it, don't forget to like and subscribe. It really helps with the YouTube algorithm, which I'm still learning a little bit more about. But I really appreciate you guys sticking through till the end. For now, I'm going to sign off. Have a wonderful day, morning, evening, wherever you are, and thanks for tuning in. Bye, guys. Till next week.